Let's say you suddenly have 10,000 euros to invest, an inheritance, a bonus, savings you finally built up. You know you want it in the market. But now you're stuck on one nervous question. Do you invest it all at once, right now? Or do you drip it in slowly, a little each month to be safe? This is one of the most common dilemmas in investing, and the answer is genuinely surprising, because the mathematically best choice and the psychologically best choice are not always the same. Today, I'll break down both approaches, what the data actually says, and how to decide for your own situation. Let's get into it. First, let's define the two options clearly. Investing everything immediately is called lump sum investing. You take your 10,000 euros and put it into the market today, in one go. The alternative is called dollar cost averaging, or DCA. You split that money into equal chunks and invest them at regular intervals, say 1,000 euros a month for 10 months. Same total amount, two very different approaches to timing. Now here's what the data says, and it surprises almost everyone. Historically, lump sum investing wins about 2/3 of the time. Studies looking back over decades of market history find that investing everything immediately beats drip feeding it in roughly 65 to 75% of the time. Why? Because markets go up more often than they go down. Every month your money sits on the sidelines waiting to be invested is, on average, a month of growth you missed. Time in the market is the engine of returns, and lump sum simply buys you more time in the market from day one. So if lump sum usually wins, why does anyone use dollar cost averaging? Because investing isn't only about maximizing the average outcome, it's about being able to sleep at night and stick with your plan. Imagine you invest your entire 10,000 euros on a Monday, and the market drops 15% that week. Mathematically, nothing is wrong, you're a long-term investor. But emotionally, watching 1,500 euros vanish in days might panic you into selling at the worst possible moment, locking in the loss. Dollar cost averaging protects you from that. By spreading your entries, you reduce the chance of buying everything right before a drop, and you soften the emotional blow of bad timing. There's a beautiful mechanical benefit to DCA, too. When you invest a fixed amount every month, you automatically buy more shares when prices are low and fewer when prices are high. You don't have to time anything or feel clever. The fixed euro amount does it for you. Over a volatile period, this can lower your average purchase price, and just as importantly, it removes the temptation to guess. You're never sitting there wondering, is now a good time? You just invest every month no matter what. So how do you actually choose? Here's a simple way to think about it. If you have a lump sum sitting in cash right now, and you can genuinely stomach the risk of a short-term drop right after investing, the data favors putting it in sooner rather than later. But if the thought of investing it all at once and watching it fall would keep you awake and tempt you to bail, then spreading it over a few months is a perfectly rational price to pay for peace of mind. A slightly lower expected return in exchange for a much lower chance of panicking. The best strategy is always the one you'll actually stick with. And here's the part that applies to most people watching this. For the vast majority of us, this debate is almost theoretical because we don't have a big lump sum, we have a salary. We invest a piece of each paycheck every month as the money arrives. And that, by definition, is dollar cost averaging. You're not choosing between the two. Your income structure has already chosen for you, and it's a great default. Investing steadily every month from your salary is exactly the calm, automatic, unemotional approach that builds wealth over decades. Let me clear up one common misunderstanding, though. Dollar cost averaging is not the same as waiting on the sidelines trying to time a crash. Some people hold their money in cash for years, telling themselves they're being careful, waiting for the perfect dip that never comes. That's not DCA, that's just fear with a fancy name, and it usually costs you far more in missed growth than any crash would. Whether you go lump sum or DCA, the golden rule is the same. Get invested and stay invested. The worst strategy of all is standing still. One more practical note: don't let this decision cause paralysis. Some people get so tangled in lump sum versus DCA that they do nothing for months, which is the one choice guaranteed to lose. If you can't decide, split the difference, invest half now and drip the rest over a few months. You capture some of the lump sum advantage and some of the emotional comfort of averaging, and most importantly, you actually start. So let's bring it together. Lump sum investing wins about 2/3 of the time, because more time in the market means more growth. Dollar cost averaging usually gives up a little return in exchange for lower risk of bad timing and a much calmer emotional ride. If you have cash to invest and strong nerves, sooner is statistically better. If not, spreading it out is a reasonable price for peace of mind. And if you invest from a monthly salary, you're already dollar cost averaging, which is a wonderful place to be. Whatever you choose, the real enemy isn't lump sum or DCA. It's staying in cash and never starting. If this helped, the next episode decodes something you see every month, but probably never read closely: your payslip, and what those deductions really mean. I'll see you there.